Today, we're going to pull back the curtain on a financial magic trick. It's the sneaky practice that's actually behind some of the biggest business headlines you're seeing right now, and it's all about creating the illusion of success, literally out of thin air.
So, what do an EV startup, a Wall Street bank, and the biggest names in AI have in common? I know, it sounds like the start of a really weird joke, right? I mean, these guys operate in totally different universes. But believe it or not, they are all connected by one shadowy financial concept. And the answer is something called the Boomerang transaction. And yeah, it's pretty much what it sounds like, something that goes out only to come right back. It's a simple name for a misleading maneuver that regulators are really starting to notice. Okay, so here's the official, kinda dry definition for you. It's called round-trip trading. Basically, a company sells something to another company, but at the exact same time, they agree to buy it, or something just like it, right back for pretty much the same price. So on paper, it looks like business is happening, but in reality, nothing of real value has actually changed hands. Or to put it way more simply, I love this quote. It's the business equivalent of paying yourself and calling it revenue. That's the heart of it. You just take some money from your right pocket, put it in your left, and declare a profit. It's all about creating this mirage of growth, often because Wall Street is always demanding more. So that's the theory, but what does this actually look like in the wild? Well, let's open our first case file. This one's a doozy. It's all about creating the one thing every company needs: customers. So you've got this EV startup, Lordstown Motors. They're getting ready to go public, and they need to look like the next big thing. So what do? They announce this staggering number: 100,000 pre-orders for their new truck. Sounds incredible, right? Well, here's the catch. When investigators started digging, they found out a lot of these so-called customers weren't real. We're talking shell companies or folks who had absolutely no money or real intention of ever buying a truck. It was all smoke and mirrors.
And that little illusion? It came with a very, very real price tag. The SEC was not amused. They slapped Lordstown with a fine of $25.5 million for misleading investors. Ouch.
All right, so faking customers is one way to play this game. But what about faking revenue directly, right on the books? Well, that brings us to our second case, the revenue loop. Now, with the tech company Supermicro, the allegation is that they basically perfected the classic round trip. Here's how it supposedly worked. Supermicro sells parts to a company that they're connected with. That company then turns around and uses that very same money to buy more stuff from Supermicro. You see the circle? It's a self-contained loop, and every time the money makes a full circle, Supermicro gets to book it as new revenue. And this is serious business. We're not just talking about a fine here. As of early 2025, the company is facing active investigations from both the SEC and the Department of Justice. The feds are definitely involved. And look, this isn't just a tech startup problem. This kind of circular thinking can pop up anywhere, even on Wall Street. Case number 3 takes us right into the world of high finance. Now, this one is pretty wild. The theory goes something like this. The investment bank B. Riley gives a huge loan to a CEO. Then, that CEO allegedly uses that exact same money to help finance a buyout of his own company. And guess who's advising on the deal? B. Riley. So the bank's money is basically boomeranging back to fund the very deal they're getting paid to orchestrate. And here's what's so interesting. The firm did its own internal investigation and said, hey, we're all clear here. But the market didn't buy it. The stock price tanked, and now they're dealing with a mountain of shareholder lawsuits. It just goes to show you, even the perception of a deal like this can have massive consequences.
Okay, so we've seen fake customers, revenue loops, and strange Wall Street loans. Now for our last case. Let's see how this age-old trick is getting a brand new, high-tech makeover for the AI boom. So here is the new playbook. Step 1. A big tech company invests, say $1 billion, into a hot new AI startup. Step 2. A huge piece of that investment isn't actual cash. It's cloud credits. Think of it like a giant gift card. Step 3. The AI startup has to spend that gift card, but only at the investor's store, using their cloud services. And here's the kicker. Step 4. The big tech investor then gets to book all that spending as brand new revenue. They are literally paying themselves through the startup. Okay, so fake customers, looping sales, circular loans, and these weird AI cloud credit schemes. They all seem so different on the surface, but let's take a step back and connect the dots.
And when you lay it all out like this, the pattern just jumps out at you. You've got Lordstown, hit with a big fine. Supermicro, facing a federal probe. B. Riley is tied up in lawsuits. And big tech is getting a hard look from regulators for this whole cloud credit thing. You can see it, right? 4 different industries, but one underlying playbook.
And that really is the bottom line here. It doesn't matter if you're selling trucks, computer chips, bank loans, or AI models. The goal is always the same. Create the powerful illusion that real business is happening, that there's real demand, and that real revenue is being generated, when it's not.
Which leaves us with this one big question. As these schemes get more sophisticated, more complex, and more woven into the fabric of new technologies, how on earth are regulators supposed to keep up? How do you spot a circle when it's designed to look like a straight line?